It's clearly springtime here in Germany in front of the Frankfurt Stock Exchange. Temperatures are improving, as is the DAX index. The DAX basically is jumping again to a new all-time high today, and sentiment for investors continues to improve. It looks like most market participants, asset managers, banks have again underestimated the first quarter development of financial markets. Basically, the DAX is already surpassing all year-end targets the major market participants set at the beginning of the year. So it's a big surprise. And so does the Bank of America investor survey published this week amongst institutional investors again show improved sentiment. They all follow the trend, they're all surprised on the upside, and they're all trying to position themselves for further rising markets. Most asset managers are trying to follow the trend, follow simple technical indicators and trend following indicators. What does it mean for the markets? What about the fundamental situation? Well, the economic situation, as confirmed by Jay Powell last night, shows a quite stable US economy on a slightly lower level, but the labor market is improving, and especially inflation is improving in the picture of the Fed for the rest of the year. That leads to the confirmation that interest rates are going to be lowered from June on. So first, interest rate downward movement in June, and then followed by September and maybe December. So 3 rate improvements are basically priced into the markets as of today. US economic indicators are still quite stable as of last week. Labor market, for example, or trucking surveys still show that there is no recession. So most economists are actually given up the recession scenario they have based on the negative yield curve. That is probably dangerous because the longevity, the time that the interest rate yield curve has been negative, is also reaching a record level. So now what about other fundamental data around the globe? Well, here in Germany, we're still muddling along the zero line. We have slightly improving service PMIs, but the manufacturing sector is still under pressure. We get new numbers from the IFO index tomorrow. We'll see how German manufacturing may be improved a little bit. So the rest of the world, if you look at China, yes, 7% growth in last year confirmed. A bit of a positive surprise, but still real estate being the problem. India having a good development, but the Indian stock exchange does not really confirm the good development with a performance of 2.5% this year. So in summary, most investors are trying to broaden their investments, get a bit away from the US equity market, which is highly valued, into Europe. You get value here, as seen behind me. We got even IPOs. We have the Douglas retail chain IPO today here in Frankfurt, and the other markets in Asia around the globe are also quite attractively valued still, or at least not overvalued. That basically means that you have to hang in there, follow the trend, maybe search for value in Europe and Asia. And probably the next turning point where we get more risky, more volatile equity markets will be when the rate cut of the Fed is confirmed in June. So it's basically then probably a sell effect and a buy the rumor and sell effect event starting from June. We probably get a more volatile summer, while we could expect maybe less volatility in fixed income markets. So stay tuned, hang in there, and diversify globally. That's the only advice we can probably give for the moment.